Hello, everyone. Welcome to video 6, I believe, of chapter 6. In the last video, we talked about specific items that were limited, certain expenses that couldn't be fully deducted. In this video, we're going to talk about specific deductions that are allowed from the Tax Act. So let's get to it. So business income specific deductions. The first deduction that a business would have to be aware of is how they are allowed to expense or value their inventory. So inventory valuations has the acceptability of either the lower of cost or fair market value for each inventory item. Fair market value of entire inventory. Accounting uses lower of cost and net realizable value. Net realizable value is what could we sell this for or how much money can we recover? But it's expected that if you were to sell this item, you'd probably get whatever the fair market value of it is. So these are two different terms that often relate to each other or are similar in value. But from the Tax Act, it's specified that it's the lower of cost or fair market value. You are allowed to select a method for valuing inventory, but they do want you to keep it consistent from year to year. Changing your valuation inventory might have big swings in what your inventory amount is, and that can drastically change income from year to year. So whatever method you choose, stick to it. And fair market value means either the cost to replace it. If this broke and I needed to buy a new one or something to replace it, how much would that cost? Or if I was to sell this, how much would I get? So replacement cost or net realizable value. Accounting focuses only on net realizable value. So fair market value, basically when measuring the price on the fair market, how much would it cost to buy or how much could you sell it for? Whichever is more available, you can use that as your basis. Exceptions for inventory of artists. The thing about art is it's very subjective in its value. Some person might say this piece of art is trash, I wouldn't pay $10 for it, and that same piece of art might go for millions of dollars at auction. So it's really hard to measure the fair market value, so they allow that art can stay at cost. Um, you can also get it valued by a third party, but that's a more complicated process. But anyway, inventory of artists, inventory of advertising and packaging material. Packaging material can't really be realized on the market because if I sell cereal, if I sell Fruit Loops, that packaging that's in my inventory is just waiting to box up the Fruit Loops I made. If I was like, oh, I want to get rid of this old packaging, let's sell it, you might have a really hard time finding someone who wants to just own boxes that say Fruit Loops. So there's not really a market for packaging, but the packaging is likely just going to sit on the shelf until it's ready for its next shipment of Fruit Loops. So it doesn't really lose value, yet it can't really be sold. So we generally just assume cost. And adventure concerns in the nature of trade have to be this is one or very few high-end items that are very expensive. So you won't really have a market. You would need to find a specific buyer, which complicates the fair market valuation. But anyway, whichever valuation method you choose, how do you determine the cost? Well, there's specific identification. If your business is a used car dealership, every car has a specified VIN number. So you can say, this car I paid $7,000, this car I paid 16. So it's very easy to identify when you have individualized products. If your products are not separately identifiable, you would likely take the average cost of them, especially when there's not really a difference between one item or another. So if I was selling canned soup, and I buy, 3 dozen at a time, this particular can's not too different from this can. So I can't specifically identify I paid 74 cents for this and 77 for that one. So you would just sort of average that cost over the cans you have. If you're not going to average the costs, for the record, when you buy shares follows the average cost system. Grocery stores use the first in, first out. So as items age, like I spent 74 cents on those soups 3 months ago. Now those soups are selling for 77. Okay, but how much did I buy? Of the cans I have left, do I think any of them hung out since 3 months ago? If I only have 6 cans, well, that's probably by my most recent order because I buy 3 dozen at a time, so 36. But if I have 50 cans, some of them are from the previous order, the rest are from the order before that. But it's assumed that every time I sell a can, I'm selling those oldest ones first. The opposite of this for for FIFO, first in, first out, is LIFO, last in, first out. This isn't really allowed to be used for tax or accounting purposes, especially in Canada. I think the states can still use LIFO in certain situations, but in Canada, we just don't allow it. So the three main are specific identification, average cost, first in, first out. Overhead absorption, when I'm making my t-shirts, the cost of running the machine, the shirt costs $10, the ink costs another two, but there's also a cost to running the machine. It's aging, it's being used up. So absorption costing is taking a portion of that cost, that what would be the amortization, and allocating it into the cost of this shirt. So directive costing is also functional. Our questions on inventory in this course don't get too complicated for inventory purposes, but just for reference, in the exercise spreadsheets, I do have this short summary of the allowances for inventory. Other deductions. So amortization's an accounting practice. It's based on management assumptions. You can't deduct amortization for tax purposes. You are allowed to deduct capital cost allowance. So Section 20 has a subsection that details of how you are allowed to deduct capital cost allowance, where it identifies, it discusses, CCA classes and the adding of cost and the disposal of depreciable property. The next section talks about incorporation costs. When you're incorporating a business, if it's a small business, it costs $300 in paperwork. If you have a lawyer do it for you, it probably costs about $1,500. If you want a very complicated share structure, it might take more paperwork, more incorporation documents in order to detail those out, which might take more time. So that might get you over the $3,000. As long as that incorporation cost is less than $3,000, you can expense it fully. If it costs you more than $3,000, you can expense up to that $3,000 threshold. Anything above gets capitalized and amortized at class 14.1 for CCA. Simple interest. If you have a loan and it charges, 5% per year, as a business, you will accrue that interest over time and you're allowed to deduct it from your income, even if you pay the interest only once a year. That's more complicated than compound interest. Compound interest has to be paid in order to affect the balance and to generate, a difference in structure after that. So expenses of compound interest are only deductible when paid. So we will accrue the simple interest over the year, and then compound interest might get deductible if there's additional amounts for compound interest once we actually make the payment. Financing expenses. When you get a loan or mortgage, especially for a business, that loan's probably going to be for, say, 3 to 5, 10 years. Mortgages have to be renewed after every 5 years. So when you apply, there might be certain expenses for the application. There's legal fees, printing costs, guarantee fees, mortgage applications. The cost associated with getting an application together for financing can't be deducted outright. You will deduct them slowly, straight line, over 5 years. And that 5-year basis, I believe, is because of the assumption that mortgages, even a 30-year mortgage, has to be renewed after 5 years, where you might have to get a new application together. So this first application is good for 5 years, so we will expense it straight line over 5 years. Our renewal application expenses will be deducted over the next 5 years. If loan fees might have annual fees, often these are called stamping fees, but they relate to standby charges, registrar fees, filing fees. You might pay these every year, and these are fees just related to maintaining the loan or mortgage. Since you pay them every year, you can expense them in the year paid, fully expensed in year incurred, rather than spread over the 5-year period. So our application fees are straight line over 5 years, but those annual fees you can just expense when incurred. We mentioned premiums on life insurance. Generally, life insurance is not deductible, but can be expensed if required by a financial institution for a loan. Small businesses might not have the profit, or at least don't have the financial history to warrant, yes, this loan's going to get paid back. So banks might force a guarantee from the principal shareholder, especially in a private corporation. So an individual is guaranteeing the loan, but if that individual passes away, well, now the bank might not get their money back. So they might require this individual have a life insurance policy taken out on them. Since it's now required for the bank to cover the loan, now it's deductible because it's related to that business activity of garnering financing. From an accounting standpoint, if we have discount on our debt obligation, so if we sell a bond for a discount, accounting says we need to amortize that discount over time. From a tax act, we say no, just deduct the interest each year, and we will discount or deduct the discount of the bond when that bond gets repaid. So applies to bonds, debentures, notes, deduction of full amount or 50% if it doesn't meet these criteria. I'm not going to go through these two items now. We will revisit this in Chapter 7 when we discuss property and passive income. We will discuss bond interest and we'll go into more detail on these criteria then. Employers who contribute to an RPP, if an employer contributes to my RPP, I don't have to add that to my income now. I will add that to income when I withdraw it. But the employer is allowed to deduct that contribution if it's paid in the year or within 3 months of year end. But basically, if they've paid the contribution, they get to deduct it from business income. The same goes for employers' contributions to deferred profit sharing plans. Profit sharing plans and RPP run by many of the same rules. And cost of cancellation of a lease deducted on pro rata per diem basis over the remaining term of the lease. So Section 18 said cancellation of a lease payment, not deductible. Section 20 jumps in to say, well, you can deduct a portion assuming the lease was going to continue. So you can deduct the portion of that cancellation fee that relates to a year of the lease not spent. But the maximum is 40 years. Not a lot of leases last that long. So normally if I have 8 years left on the lease, that cancellation fee will amortize over those 8 years. Landscaping cost, and the same goes on the next slide, utility service connections. We might consider both of these items to be capital in nature. Landscaping cost, this could be a capital cost relating to a piece of land. If I do, let's say I put in some weeping tile or some drainage ditches on a piece of land to help deal with, moisture or water if it's farming. Those landscaping costs could be argued to be capital in nature, but Tax Act Section 20, subsection 1, AA says if once it's paid, just deduct it all in the year. They're not going to track landscaping costs. And if you have a utility service connection connected to a building, you could say, well, that's capital for the building, right? But they just say, no, just deduct it fully. Expenses of representation. This is the section that says you can deduct those legal expenses related to obtaining licenses, permits, franchise trademarks, patent costs, payments to professionals to obtain advanced tax rulings or prepare voluntary disclosures, as long as it relates to business carried on by the taxpayer. So this is the function that says legal fees paid for business pursuits can be deducted. When we're talking about property we're purchasing, so if I want a new property, I have site investigation costs. I want to put up a new manufacturing facility. So there's 3 spaces I might want to buy, but I have to check is the bedrock strong enough to hold the building? Is there land pollution we have to clean up first? Is there degradation, erosion, yada yada? So I might check these 3 sites, but I'm only picking one of them. So the one I buy, those costs can be incorporated into the capital cost and amortized, but for the sites I don't go for, I'm not capitalizing those. There's not going to be any CCA. but it was a business-related transaction. So they say site investigation costs can be argued to be capital in nature, but those preliminary costs are suitable and allowed for year paid. Disability-related costs, augmenting a business place to allow accessibility service, perhaps a ramp, an elevator, um, that's deductible in year paid. Visual fire alarms, another example. Conventions. This is kind of important detail. You'll likely see a question like this pop up. It is understood that a lot of businesses go to conventions. They go to advertise their product. They go to meet with other players in the industry. They might be reaching out for potential customer bases. The location must be consistent with your territorial scope of the organization, meaning it must be consistent with where you're producing your product or where you might be selling it. But you can deduct no more than two in a year. Now, I've worked for companies that go to several conventions in a year, but you would tally up the two most expensive conventions and you would deduct those. So if you only get two, you can take the best deductions you can. So if you went to 4 or 5 conventions, find those two most expensive and deduct those. Other limitations on deductions. So these tax sections follow that 9, 12, 18, 20 rule. Those are specifically identified limitations and deductions. Once you're done, it then looks at the concept of reasonableness. So reasonableness allows a portion of an expense that is reasonable, but still linked to an existing source of income. I mentioned this before about the hotel. If it's deemed that a portion of the expense is unreasonable or goes beyond what is necessary for business, you still get to deduct only the reasonable portion. So a $900 expense might be reduced to just $150 for reasonableness. So to determine that, they look at what would a business person in a similar circumstance have done. All of the other business persons, they paid $100 a night. They might have paid $150 per night. So generally that's what a reasonable person would do. So your expense will be limited to that. It's commonly applied by the CRA in non-arm's length situations. So this comes into family businesses to say, yes, we paid for my sales associate to go to Hawaii, but my sales associate is also my sibling. And so perhaps I'm willing to use my business to give them extra treats and extra gifts. So they really scrutinize non-arm's length transactions, but the concept of reasonableness can fall into any business transaction. So for reasonability, meals and entertainment are only 50% deductible. This goes for meals, ticket costs for concerts, theaters, events, entertainment at guest clubs, cruises and vacations, private boxes. The idea being, I need to take out a supplier or a customer. I'm trying to make deals. I want to woo someone, so I will pay for them to have a nice evening. We'll go to dinner, we'll go to an event, and hopefully that garners a relationship that we can do business with in the future. Yes, that is a business action. But when I go for a meal, I'm enjoying a meal too. I'm enjoying a night out. So the CRA says you can deduct the portion that's for the client, that's for business. The portion that you're benefiting from is not deductible. But they don't want to go through every receipt and every ticket and goes, oh, do you like the Taylor Swift concert? Did you have the steak? So they just say, let's just split it in half, 50-50. Your part's non-deductible, the client portion is. There's some exceptions. Long-haul truckers are expected to do their work away from home and they don't have access to, their own kitchen. So their meals are 80% deductible. If you provide meals for a fee, if your business is a restaurant and you're buying food for cooking, those meals prepared are for customers, but it is your business. So if it's your business, it's fully deductible. If it's a fundraising event, any reimbursed costs can't be deducted. So if I pay for a client's meal, but then they pay it back to me, say, oh, here's the $100 I owe you for dinner. Now I can't deduct that dinner anymore because I was reimbursed. Employees at a remote work location, similar to truckers. If I have employees, if I have an oil company and I have employees on out on an oil rig in the middle of the ocean, they can't go to a restaurant. They can't hit the grocery store and get some food. So I need to provide them meals while they're there. So that's fully deductible because they don't really have an alternative. And I'm allowed to have special events. I could have a summer barbecue. I could have a holiday party. Maybe I can celebrate an anniversary or a retirement party. Generally, a company gets six events that are fully deductible for you and your staff each year. Okay, I want to stop this video here. In the next video, we're going to go into automobile costs and what can be deducted from the point of view of the business. Thank you for your time. See you in the next video.